Hello class, this is Dr. Fenton. In this video, we will cover Chapter 7, which talks about planning for profit and cost control. But really, what this chapter is all about is budgeting, the budgeting process. We're going to cover a variety of budgets, so let's get started. Now, all of us use budgets to some extent. Some of them are formal budgeting, where we actually write it down and be very precise. Other types is we just think about it. How much am I going to spend for this or that or whatever? Maybe you've done this about going to college. What are your costs on going to college? Tuition and books and fees and so forth. Do you have enough earnings or enough savings to pay for college? So we all are faced with budgeting, but let's see what we do with companies. Okay. Now, companies will do something called strategic planning. This is budgeting in the sense that you're planning for the overall future of the company. Which direction do you want it to go? What kind of products do you want to have? Strategic budgeting is not covered in detail in this chapter. That's for other courses that you'll take in your business college career. Capital budgeting. We have a later chapter that covers this. This is focusing on purchasing long-term assets. So if you have an asset that's going to last 5 or 10 years, should you buy it or not? Will it pay for itself? Will it help the company earn higher profits if you buy that asset? So again, that's for a later chapter. This chapter is going to talk about operations budgeting. Even though it says short-term plans here, it could be for not just a year, but several years, if you want to think of it that way. A lot of companies will have budgets month by month. And what they'll do is for every aspect of their business, they will budget for that, whether it's sales, cash flow, production, whatever. They'll plan for it month by month. And if they have a perpetual or continuous budgeting process, they might have a budget for 12 months. But as one month ends, they'll add another month on the outer end of that in the future. So they always are looking forward 12 months. So what's the advantage of budgeting? I'm sure you already know that. It helps you plan better. It helps you coordinate, especially within companies, from one department to the other. Like the example here says, a purchasing agent may order a large quantity of raw materials to obtain discounts from suppliers. But if you buy a lot of materials, then the inventory supervisor has to worry about, where do I store this? So budgeting helps different departments coordinate their plans. Performance measure, if you budget a certain amount of sales or to spend a certain amount of money on a project, then after that time period expires, you go back and look. Did we make budget? Did we exceed budget? Were we lower than budget and so forth? And you use that for better planning in the future. Corrective action, this is a big point here. If you're in the production process, then you're going to plan your production for the whole year coming up, month by month. And you're going to see whether you're going to have bottlenecks, whether you're going to have supply shortages. What about cash? Do you have enough cash to pay for payroll and production and so forth? So it helps you look into the future and see where you need to plan ahead, maybe to make borrowing arrangements or whatever. And budgeting and human behavior, yes, it all ties together. If you have just the upper level management preparing budgets, people in the operations area of the company might think, well, I did not prepare this budget, therefore I really should not be judged on it, or maybe it's not reasonable. So if you can get more people in the organization to participate, you'll have more buy-in, probably better information, from the bottom up, for the people out in the field about marketing and so forth. And so it's good to have everyone possible involved in budgeting. Now, the master budget is just a group of detailed budgets, and we're going to cover a variety of these. You can see that we're going to talk about a sales budget, an inventory purchases budget, a selling administrative expense budget, and a cash budget. So master budget is just a group of all the operational budgets for the entire company. And let's see. Yeah, all right. Yeah, so here's what we do. We're going to go through each of these kinds of budgets in detail in just a minute. Everything is based on the sales budget. So you get the marketing people together and decide, what do we think we can sell for this year coming up? That's going to help you find out, well, we make sales, when and how much cash do we collect? How much inventory do we need to purchase to be able to sell it? Inventory is going to help you decide, what about cash payments? And then that's also going to help with the selling and administrative expense budget. And you worry about the cash payments for it also. Once you have these cash flow numbers, then you can prepare a cash budget. All this information will help you prepare what's called pro forma financial statements. Those are just prediction-based financial statements. In the previous course, your Accounting 200 course, you prepared financial statements based on historical data. The year just ended. Let's prepare the 4 financial statements. Here in budgeting, we're going to prepare forward-looking financial statements. Like a year from now, what will the income statement look like? What will the balance sheet look like and the cash flows? So pro forma financial statements is just a fancy way of saying budgeted financial statements. Talks about this company. They sell a single product, and if they run short of cash, they have to make arrangements with the bank to borrow money. First of all, the sales budget. You get your marketing team together. They do all kinds of economic analysis, marketing surveys, and so forth, and decide on what they think they're going to sell for the year coming up. And I think the company's also offering, or they're opening some new stores. So what they will do, and this is a great example here, your budgeting process really should be put in Excel. It makes things so much easier. I wish we could see the actual formulas in each of these cells in Excel, but we cannot see that. It's just a picture. But that's what you really need to use in budgeting. Use Excel. What they've decided to do is say, all right, we think in October, for this new store, I think it is, we're going to sell cash sales $40,000, sales on account $120,000. So our total budgeted sales for October will be $160,000. They also, in the reading, if you go back and read the paragraph surrounding this, they're going to increase, they think sales will increase 20% every month. So take 1.2, 120% times $120,000, and that'll give you $144,000. If you take $144,000, I'm looking at the sales on account as an example, you'll take this times 1.2, and that'll give you $172,800 on predicted sales on account. Do the same thing for the cash sales and the overall sales. So here's what they first predict, and then they think all these sales will go up 20% month after month. Now, this is a simple sales budget. It's very, very simple. This helps us find out something about cash. So if we predict, again, these are predictions, if we predict we're going to have cash sales of $40,000 in October, then that's what we predict to collect in cash in October. Just makes sense. They're also assuming that any sales on account in any one month will not be collected until the next month. That's why this $120,000 sales on account in October doesn't show up as a cash collection until November. That's just the assumption this company makes. They could have made a little bit different assumption on this. They could have said part of this sales on account in October will be collected in October and part in November, but they're just giving a simple example here and saying any sales on account in one month is not collected until the next month. So let's look at this. In November, they expect cash collections of $48,000, drops in right here in the cash budget. But their sales on account in November will not be collected until December. Okay. And now if you think about it, we're going to see this number pop up in just a minute. In fact, that's what it says here with the A. Whatever we expect to have as sales on account in December, that will not be collected until the next year in January. And so this $172,800 is going to be our quarter end, and maybe year end if they have a December 31st year end, accounts receivable balance on the balance sheet. So we're going to see this same number, sales on account in December, showing up as accounts receivable on the balance sheet at the end of December. And for the budgeted income statement, we're going to have all these sales here for total for the quarter on the income statement. So the sales budget is where you start with everything. It will be used, and we'll see it in just a minute, to see how much we need to purchase in inventory. We start with the cash budget. This start is just a very small part of the cash budget. We're going to see a bigger one in a minute. So all the reading down through here is just explaining what is just talked about. So you can read this. Inventory purchases budget. How much inventory do you need to purchase every month to cover the sales you expect to make that month? And add to that, what kind of inventory balance do you want to have at the end of the year? Or I should say, at the end of each month. So let me bring this down a little bit, and they say, it's the company's policy to maintain an ending inventory equal to 25% of the next month's projected cost of goods sold. So, we need to have enough inventory. In other words, we need to buy enough inventory to cover the current month's sales, plus have inventory left over equal to 25% of the next month's predicted sales. That gives us total inventory. If we have any beginning inventory coming into this month, that means there's that much we don't have to buy. Let's cover this again. We need to have enough inventory. In other words, we need to buy enough inventory this month to cover this month's sales, have some inventory left over. That's a total here, subtotal. That's what we totally need this month. But if we start the month off with some inventory, subtract that out, that gives us how much we need to buy, actually purchase this month. Let's put some numbers to it. Now, this example here has a lot of numbers in it. Just take it one column at a time and you'll be okay. So, if you notice here, budgeted cost of goods sold. This is based on what we think we're going to sell this month, but this is your inventory cost. This is not your selling price. Look down here in the explanation. For October, they had budgeted $160,000 in sales. That's your selling price. You don't pay that much for it. And they say they usually pay 70% of the sales price, and that's their actual cost. So in other words, they'll buy inventory that costs them $112,000, and they will sell it for $160,000. So don't put your $160,000 up here. This is your budgeted cost of goods sold. This is not your budgeted sales. Yes, it is based on your sales, but it's 70% of sales, so your actual cost of your inventory. They also said they would like to have here 25% of the next month's inventory at the end of October. So whatever they expect to sell in November, which is $134,000 for, 25% of that needs to be here at the end of October. So we can start the month off in November with plenty of inventory and ready to make sales. So our inventory needs for this month, $145,600. Since this is the first month of operation for this store, we don't have any beginning inventory. So we have to buy $145,600 worth of inventory for October, and that will cover October sales and the inventory left over at the end of October. And what they do here, if you want to look at the cash, part of the cash budget here, what they say is whatever we buy during a month, we're going to pay for 60% of that in that same month. So 60% times 145,600 is the $87,360. The rest of it will be paid in the next month. So 40% of 145,600 is being paid in November. So of our October purchases, these are the purchases in October. We have to buy this. But we're going to pay for it 60% of this in the same month, October, 40% next month in November. So you work it through the same thought process for every month. A little bit of difference here because they have the beginning inventory. Let's cover November. Now, November's cost of goods sold budget is 70% of November's expected sales. Go back to the sales budget and look at that number. We also, for the ending inventory, remember, it's 25% of the predicted next month's sales. So if we expect to sell 161,280 in December, 25% of that needs to be on hand at the end of November. Add it, our total inventory needed for November, but here we did come into November with some inventory already on hand. Pull that away. This is a subtraction, so we only need to purchase 141,120 in November. Our inventory. We need 174,720, but we have 33,600 on hand at the beginning. We only need to purchase 141,120 during November. How do we pay for this? 60% of your required November purchases will be paid for in November, 84,627 or 672. The 40% of 141,120 will go over here to be paid for actual cash flow in December. So don't let all these numbers throw you. Go back through this on your own, one number at a time, 1 month at a time, and follow all these numbers through here and here. Okay. All right, so that is the purchases budget, and they're showing us cost of goods sold for the 3 months. All these numbers across here. And we are going to see that the accounts payable balance at the end of the year to be reported on the pro forma balance sheet will be 40% of December's purchases. That's what it is, 40%. So 62,384 will be showing up on the balance sheet we're going to look at in a few minutes. And that's the ending balance in accounts payable on the balance sheet, because we're going to pay for 40% of the December purchases in January. So this will show up on the balance sheet as accounts payable. Read through this. This is an explanation of what I just talked about. Let's go to the next page. Selling and administrative expense budget. Okay. This will relate to what we think we're going to pay for, or really incur, I should say, at the beginning here. Incur as to selling and administrative expenses for these 3 months. And they do some talking here about where some of the numbers are coming from. So, this is just a budget for the expenses, right? So projected selling administrative expenses. They think, well, we're going to have salary expense, 24 each month. Sales commissions will be 2% of sales. Okay, so 2% of sales. So whatever our sales were in October, 2% of that will be commissions. Supplies expense, they think it's going to be 1% of sales. So remember, we had $160,000 of sales for October. That's what the expected sales. And so that's going to help us determine commissions and supplies expense. Utilities expense, they just estimated that. Does not come from another statement. Depreciation on the store fixtures, they came up with that. That's based on your furniture and fixtures that you have. Rent here, and miscellaneous, $900 per month. So this will be the selling and administrative expenses before any interest expense for each of these months. This is the accrual method. Remember that from the first accounting course. This does not represent cash flow. Here is the cash flow part of the expenses. These numbers will show up in the income statement. But as to cash flow, we need to go through and figure out what are we paying each month. So they're going to pay the salary in cash each month. But look at commissions. Now commissions for October, 2% of October sales, their policy is we pay commissions a month after they are earned. So that's why this $3,200 in October commissions that belongs here in October as an expense, cash-wise will not be paid until November. November's commissions will not be paid until December. Now, supplies expense, that'll be paid cash every month. Utilities expense, well, this is their estimate for utility usage each month, so that is an expense each month. But they probably will not receive the bill until, just after the month ends. So the $1,400 estimated utilities expense for October will not be paid for until November. Same way November will not be paid for until December, and December's utilities expense will not be paid for until the next year into January. Rent is paid each month, cash, as well as your miscellaneous expenses. Now, they don't give a lot of explanation below here about that. But again, this is an accrual basis estimate of your selling administrative expenses. This is the cash flow related to that. So just because they have an expense one month, like commissions, and it belongs in this month, doesn't mean we're going to pay the cash that month. It's not paid out until November. And then some of these numbers will be used then to help us prepare the formal financial statements, and they explain about this. Commissions payable in January. So you're going to see on the balance sheet and liabilities, sales commissions payable. It's going to be the December sales commissions payable in January. And similar with all these others. Next page. The cash budget. Okay, now we have to put all the different cash amounts together and decide how much in total cash is coming in, how much is going out, and do we have enough in our bank account to pay for everything. So in October, we start the month off, brand new store, zero cash. We expect to receive from customers $40,000. So that's our total cash available, $40,000. Go back to your inventory purchase budget. Look at the cash portion. We expect to pay out for inventory purchases $87,360 in cash. In selling administrative expenses, go back to Exhibit 7.4, $30,100. And they also said, well, we need to buy in this first month store fixtures. And that was not in a previous budget. That's just something they told us in some of the reading a page or two ago. So this company for October expects to pay out in cash $247,460. That's quite a bit compared to the cash coming in. We only expect to receive from customers cash of $40,000. We're going to pay out over $247,000. Now, if you go and read the detailed reading about the cash budget, you're going to see that this company expects, or really, they desire to have an ending cash balance of minimum $10,000. Minimum $10,000. But if they expect to pay out $247,460 and only have $40 coming in the door, find the difference. We're going to be short $207,460. We are way short of cash. So we have to borrow the money. So we have to borrow enough to have at minimum $10,000, and we borrow in $1,000 increments. So to get from a negative $207,460 to at least a $10,540, balance, at least $10,000, we're going to be a little bit more, we're going to have to borrow $218,000. Now, if we borrow only $217,000, we're going to be short. It's going to be like a negative $460. That's not going to cover it. So jump up one more $1,000 amount in borrowing. So $218,000 will pay for the cash that we need here, our shortage, plus give us at least $10,000 in the bank account at the end of each month. So go through every month and do the same thing. They had to borrow a little bit more in November because they're coming up short. And then here, they actually can start paying some back. That's what the negative is here. So once you have enough money, you can pay back enough that will still leave you $10,000 here. Minimum $10,000. One thing to watch out for, your ending cash balance one month is the same as your beginning the next month. So this 10,540 is up here. And in November, 10,428 is up here. That's cash we can use that month, so it goes into these calculations. So that's the cash budget. Yeah, and the pro forma data. Let's get to the pro forma statements. Here we go. The income statement. This format, of course, looks very familiar to you. Just go back to Exhibit 7.2, pick up all the sales they predicted for 3 months. Same with cost of goods sold. And they're showing you where all these numbers are coming from. So go back to each of these exhibits, if you need to, and see where these are coming from. Now, interest, we didn't talk about that. Let's go back and look at the interest here. The interest expense is right here. They calculated that for us. And so you borrowed money 1 month, then you have interest expense starting to accrue here. And then the next month you borrow a little bit more, you have more interest expense. That's where interest expense is coming from for the pro forma financial statements. There's the income statement. There's the balance sheet. And again, you can go back to each of the previous budgets and they'll show you cash balance end of the year expected to be $10,660. Receivables, we talked about that in Exhibit 7.2. So go back to each of these and they will explain and show you where all these numbers come from. So a pro forma set of financial statements is nothing but a budgeted set of financial statements. Not historical numbers like we're used to preparing, but what we think is going to be the situation, let's say like a year from now. You can do the same thing with the cash flow statement. Now, I'm not going to have you prepare a cash flow statement on the exam, so don't worry about that. I would expect you to be able to prepare an income statement and balance sheet, so that's possible. But don't worry about the cash flow statement. Just know that you can prepare a pro forma, in other words, a budgeted statement of cash flows. Let's see what else. There we are at the end of the chapter again. So you can look at the review problem if you want to. A good example here. As always, go back and read the chapter. Read it word for word and follow all the numbers through on the examples. Okay, good luck with your studies.